You hear stocks and bonds mentioned together constantly, but if someone asked you right now to explain the difference, could you? Most people can't, and that gap has cost investors more than they realize. Stocks, bonds, and the balance between them. That is what we are covering today. 3 concepts that every investor needs to have locked in. Welcome to Grace Investing. Let's start with a simple scenario. A small coffee shop owner wants to open a second location. She needs $200,000 to make it happen. She comes to you with 2 options. Option 1. Give her the money and own 20% of the business. You're now a part owner. Option 2. Loan her the money at 5% interest per year and she pays it all back in 10 years. You're now a lender. That distinction, owner versus lender, is the entire foundation of stocks and bonds. When a company wants to raise money from the public, it divides itself into millions of equal pieces called shares. Buy a share and you own a slice of that business, its profits, its assets, its future upside. Stocks generate returns in 2 ways. Capital gains, the stock price rises and you sell for more than you paid. And dividends. Some companies distribute a portion of their profits directly to shareholders as regular cash payments. Not all companies pay dividends. Fast-growing companies often reinvest every dollar back into the business instead. What drives the price? Earnings, industry momentum, broader economic conditions, and what investors believe the company is worth in the future. That last one is the dangerous part, because belief can shift fast. In a good year, that coffee shop stock you bought for $200,000 could be worth $300,000. In a bad year, the same investment could drop to $120,000. That volatility is not a bug, it is the defining feature of equity. Here is what ownership actually means in practice. If that coffee shop grows into a regional chain worth $2 million, your 20% stake is worth $400,000. You turned $200,000 into $400,000. But if the business goes under, your stake is worth exactly 0. Stocks have no floor. That is the trade-off you accept when you buy equity. Now let's talk about bonds. When you buy a bond, you are not buying ownership, you are making a loan. The borrower, called the issuer, could be the U.S. government, a corporation, or a city. In exchange for your money, they commit to 2 things. First, they will pay you a fixed interest amount on a regular schedule. This is called the coupon. A $1,000 bond at a 5% coupon pays you $50 per year, typically $25 every 6 months. Second, at the end of a set term, called the maturity date, they return your full principal. Bond terms typically range from 1 year all the way to 30 years. You know exactly what you are getting and when you are getting it. That predictability is the whole point. That reliability is also why bonds are categorized as fixed income. The payments are fixed. The schedule is fixed. As long as the issuer holds up their end of the deal, you know exactly what you will earn. Here is where bonds get more interesting and where most beginners stop paying attention. Bond prices move after they are issued. Here is why. Say you own a bond paying $50 per year on a $1,000 face value. Now imagine the Federal Reserve raises rates and new bonds are being issued paying $60 per year. Your bond suddenly looks less attractive. Why would anyone pay $1,000 for $50 a year when they can get $60? They would not, unless your bond was priced lower to make up the difference. The same logic works in reverse. If rates fall and new bonds only pay $40, your $50 bond looks incredible. Investors will pay more than $1,000 to get it. The rule is simple, but it matters. When interest rates rise, bond prices fall. When rates fall, bond prices rise. They move in opposite directions, always. Bonds are lower risk than stocks, but they are not risk-free. 3 risks matter here. Credit risk. If the issuer defaults, you may not get your coupon payments or your principal back. Bond ratings help you assess this, but ratings can change. Interest rate risk. If you need to sell your bond before maturity and rates have risen, you will likely sell at a loss.
If you hold to maturity, this does not affect your principal, but it affects your options. And inflation risk. A bond paying 3% looks a lot less appealing when inflation is running at 4%. Your income is technically fixed, but its real purchasing power is shrinking.
That contrast, roller coaster versus escalator, is the clearest mental model for what separates stocks from bonds. One offers higher potential with real downside. The other offers predictability with a lower ceiling. Let's put them side by side. Ownership. When you buy stock, you become a partial owner of that company. When you buy a bond, you are a lender, no ownership whatsoever. Income source. Stocks return money through dividends and price appreciation. Bonds return through fixed coupon payments. Risk level. Stocks carry higher risk. Prices can and do fall dramatically. Bonds carry lower risk, but credit, rate, and inflation exposure are all real. Return potential. Historically, stocks outperform bonds over long time periods. Bonds deliver lower but more predictable returns. Portfolio role. Stocks are your growth engine. Bonds are your stability layer and income buffer. Both have a job. The question is, how much of each? So, how do real investors actually use these two assets together? That depends almost entirely on one thing: how much time you have before you need the money. Consider two investors. Marcus is 30 years old, with retirement 35 years out. His portfolio is 85% stocks and 15% bonds. He can absorb a bad year, or even a bad 3 years, because time is on his side. Now take Diana, at 58, retiring in 7 years. She has shifted to 35% stocks and 65% bonds. She is not trying to maximize growth anymore. She is protecting what she has built and generating reliable income as she approaches retirement. Same two assets, completely different allocations, because the goal is different. There is a simple starting rule worth knowing. The classic version says your bond allocation should equal your age. 30 years old means 30% bonds. But many modern advisors use 110 minus your age instead, because people are living longer and need their portfolios to keep growing further into retirement. 110 minus 30 gives you 80% stocks. These are starting points, not mandates. Your actual allocation depends on your risk tolerance, income stability, and goals. But the principle holds. The older you get, the more you shift from growth toward preservation. That is what getting the balance right actually looks like. Not a dramatic windfall, just the quiet confidence that your money is positioned to carry you where you want to go. 3 things beginners get wrong. First, bonds are boring, so why bother? Investors who ignore bonds entirely often discover near retirement that a single bad market year can devastate years of savings. Bonds exist for a reason. Second, bonds are totally safe. They are not. Defaults, rising rates, and inflation are all real risks. Lower risk is not zero risk. Third, you have to choose one. You do not. Almost every serious portfolio holds both, in a ratio that reflects where the investor actually is in life. Stocks and bonds are not competitors. They are partners. Each one does something the other cannot. Together, they build a portfolio that can grow and survive, in good markets and bad ones. 3 things to take from this. 1. A stock is ownership, higher ceiling, real downside, and returns driven by how well the company and market perform. 2. A bond is a loan, predictable income, lower risk, but credit risk, interest rate sensitivity, and inflation exposure are all factors. 3. The ratio between them, your asset allocation, is not set and forget. It should evolve as your timeline gets shorter and your goals shift. Drop a comment below. Are you naturally a stock person or a bond person? And what is your current thinking on your allocation? If this gave you a clearer picture of how these two actually work, the like button helps more people find it. Stay sharp.